So credit card debt is still a big problem, even though the Fed didn't hike interest rates. And the last Fed rate increase was back in July when Jerome Powell went up 25 basis points, which pushed the federal funds rate up to 5.5% from 5.25%. And despite the Federal Reserve's decision not to increase its benchmark rate, Americans with credit card debt won't see any immediate relief either. And the reason for this is because interest rates on credit cards, closely tied to the central bank's rate, remain near 4-decade highs and could see a rise further before the year is over. And right now, the average credit card annual percentage rate, or APR, is currently around 20.71%, with store credit cards often exceeding 30%. So that shit is crazy and ultimately will lock people into debt cycles for the rest of their lives if they aren't careful. And if they're not able to get their spending under control their spending. Now, wisdom doesn't automatically come with credit card approvals. And unfortunately, that is bad. Plus, the outstanding credit card debt in the U.S. has already surpassed $1 trillion, which is a record high. And despite these unbelievably high interest rates, the situation is further exacerbated by increasing credit card delinquencies, with over half of cardholders unable to pay off their full balance each month. And I read in a recent business periodical how Matt Schultz from LendingTree advises cardholders to anticipate further rate increases and to actively work on reducing their credit card debt. Smart plan. Now, to combat this high interest rate, or these high interest rates for that matter, Schultz suggests negotiating with your credit card company for a lower APR, which is a strategy that has been proven successful for many cardholders, or transferring balances to 0% APR cards that have this introductory rate. But the key there is to pay off the debt fast and not to rack up more in the process. Now, he also recommends building savings alongside debt reduction, taking advantage of higher savings account yields, which have increased significantly due to recent rate hikes, because this simple approach can help anyone break the cycle and provide a financial buffer for future emergencies like medical expenses. Medical emergencies or unexpected medical issues can lead to significant expenses, especially if they require hospitalization, surgery, or expensive medications. Job loss. Losing a job can be a major financial setback, especially if it's sudden and without severance pay, impacting the ability to meet daily expenses and pay bills. Home repairs. Significant home repairs, such as a damaged roof, plumbing issues, or electrical problems, can be unexpectedly costly. Car repairs. And for many people, a car is essential for getting to work or managing daily tasks. And major car repairs can be an unexpectedly expensive burden. Think about it too. If you're running a Uber or Lyft or any ride share service or delivery service, and your car needs extensive repair, substantial repair, you gotta get it fixed. Otherwise, you're out of business. Family emergencies and these events, such as a death in the family or needing to care for a sick relative or other family crises, can result in unforeseen expenses. Natural disasters, earthquakes, floods, hurricanes, or other natural disasters can cause significant damage to property, leading to further unexpected expenses. Legal issues, legal troubles, such as a lawsuit or the need for legal representation, can be a significant unplanned expense. The educational expenses, sudden changes in educational funding or requirements can create financial strain, such as needing to purchase expensive textbooks or equipment, or student loan repayments kicking back up again. Tax bills, the IRS wants their pound of flesh, and an unexpected tax bill, perhaps due to an error or an underestimation of owed taxes, can be a sudden financial burden. And finally, circling back, right around back to credit cards and credit card debt. High interest rates and penalties can quickly turn manageable credit card debt into a financial emergency. And granted, it's important to note that what constitutes a financial emergency can vary greatly depending on everybody's own personal circumstances and financial stability. Job, employment, dependency, living expenses, etc. And actively preparing an emergency fund and having different layers of insurance can help mitigate the impact of these emergencies. Now, I will attest to the truth of being prepared and mitigating various risks, since having worked hard to pay off credit card debt and striving towards being debt-free, which can bring a multitude of benefits both financially and emotionally. Now, I made a list of some of the key reasons and personal feelings associated with this goal. And I'm going to start with the first one being the financial benefits. And number one, saving money on interest. Credit card debt often carries high interest rates. Paying it off can save a significant amount in interest payments. Improved credit score. Reducing debt can positively impact your credit score, which can be beneficial for future loans, mortgages, or even job applications in some cases. And honestly, I got to tell you guys, the easiest way, a lot of people say, well, they'll ask, how do I get a higher credit score? Pay off all your credit cards. That's the easiest way to get a higher credit score. Or how do I get a higher credit card limit? Pay off your credit card. You'll get a higher limit. Now, also increases your financial security. This is key. Being debt-free means more disposable income and less financial risk, offering more stability, leading to enhanced retirement savings, because without debt, you can potentially allocate more funds towards retirement, securing a much better financial future. Facilitating better financial planning by being debt-free, which allows for more accurate and effective financial planning and budgeting. And next on the list, we're going to touch on the emotional and psychological benefits. Number one being a reduction of stress. Stress reduction is huge, and debt can be a significant source of stress, and eliminating it can lead to a more relaxed and peaceful state of mind. Sense of accomplishment. Whereas paying off debt, especially substantial amounts, can be a huge achievement, boosting self-esteem and confidence. Improved mental health overall, where financial worries can take a toll on people's mental health, and being debt-free can alleviate anxiety and depression related to financial strain. Increased freedom and flexibility, because without the burden of debt, you might feel freer to make life choices like changing careers, traveling, or pursuing hobbies. The empowerment in financial decision-making, as clearing debt can lead to a sense of empowerment and control over one's financial situation, leading to better relationships, because financial stress can strain relationships. Being debt-free can reduce these tensions and improve personal relationships, leading to peace of mind for the future and a financial future. Knowing that you're not burdened by debt can provide peace of mind, especially regarding future uncertainties like health issues or job security. And also the long-term perspective, where we set a positive example. And for families, being debt-free can set a positive financial example for children. And this contributes to a stress-free retirement. And looking towards retirement, being debt-free can contribute to a more secure and enjoyable retirement phase. Moving on to legacy planning, and being debt-free allows for better planning and management of your legacy and assets. Now, to be honest and transparent with you guys, while the journey to becoming debt-free can be challenging, the combined financial, emotional, and psychological benefits make it a worthwhile pursuit for anyone who strives to accomplish this goal. And I have seen how personal motivation often stems from a desire for financial independence and security, and the peace of mind that comes with being free from financial obligations to creditors and after having been trapped by them for so long. Game changer. Now, Dave Ramsey has an easy and simple approach to knocking this out too. And I would say that even though I'm not a financial advisor by any stretch of the imagination, any way that anyone chooses to become debt-free is more than likely going to be greater than not. And hey, if you guys like these types of videos and want to see more, then just smack the like button and subscribe. And good luck on your journey to becoming debt-free.